Good morning, everyone. Welcome to our first lecture in the course on e-banking. I'm Dr. Magda Mustafa Sadiq, Associate Professor of Economics in the Faculty of Economics, Financial and Banking Studies, Department of Banking, Sudan International University. I'm delighted to begin this course with you because electronic banking is one of the fastest growing areas in modern finance. The banking industry has changed dramatically over the last 3 decades, moving from paper-based operations and long queues in bank branches to digital services that customers can access instantly from their smartphones. Today, almost every financial institution invests heavily in digital technologies because customers expect banking services to be fast, convenient, secure, and available 24 hours a day. Whether you plan to work in commercial banking, central banking, financial technology, or financial management, understanding electronic banking has become an essential professional skill. Throughout this course, we will examine not only the technologies used in banking, but also how they influence customer behavior, financial inclusion, banking competition, and economic development. Today's lecture serves as a foundation for all future lectures. Let us begin. Introduction to e-banking. Before discussing the details, let us look at what we will learn today. This lecture covers 6 major topics. First, we will define electronic banking and explain what it means. Second, we will examine the historical evolution of electronic banking, showing how banking has changed over time from manual operations to today's intelligent digital systems. Third, we will study the different types of electronic banking, including internet banking, mobile banking, ATM banking, digital wallets, and electronic payment systems. Next, we will compare traditional banking with electronic banking so that you will understand their major differences. We will then discuss the benefits and challenges associated with electronic banking. Finally, we will examine digital transformation in banking and understand why technologies such as artificial intelligence, cloud computing, blockchain, and big data have become so important. By the end of today's lecture, you should clearly understand the concept of e-banking and appreciate why digital transformation has become a strategic priority for banks around the world. Let us begin by defining what is electronic banking. Now let us define electronic banking. Electronic banking, often abbreviated as e-banking, is also known by several other names. You may hear people use the terms online banking, internet banking, or digital banking, although there are slight differences in meaning. These terms generally refer to banking services delivered electronically rather than through traditional bank branches. Electronic banking allows customers to perform financial transactions using computers, smartphones, tablets, automated teller machines, or other electronic devices. Instead of traveling to a branch Customers can check account balances, transfer funds, pay utility bills, apply for loans, receive account statements, and manage investments from almost everywhere. According to the Bank for International Settlements, electronic banking is the delivery of retail banking services through electronic channels. This definition highlights an important point. Electronic banking is not simply about using computers. Rather, it represents an entirely new method of delivering banking services. Today, customers expect banking to be available whenever they need it, whether it is early in the morning, late at night, or during holidays. Electronic banking provides continuous access. Think about your own experience. Many people now use mobile banking applications more often than they visit bank branches. Some customers may go several months without entering a physical bank because nearly every banking services can be completed electronically. This shift has fundamentally changed customer expectations and has encouraged banks to invest heavily on digital technologies. Electronic banking benefits both customers and banks. For customers, it provides convenience, flexibility, and faster service. For banks, it reduces operating cost, improves efficiency, increases customer satisfaction, and expands access to financial services. As technology continues to advance, electronic banking is becoming the standard rather than the exception. Let us come to the evolution of e-banking. Phase 1 and Phase 2. Electronic banking did not appear overnight. Its development occurred gradually over several decades. Let us begin with the first two phases. The first phase was traditional banking, which existed before the 1970s. During this period, banking was entirely manual. Every transaction required customers to visit a physical branch. Bank employees recorded transactions on paper documents and maintained customer records manually. If someone wanted to withdraw money, deposit cash, or transfer funds, they had to travel to the bank during official working hours. The process was often slow and long queues were common. Although this system worked for many years, it had several limitations. It consumed considerable time, required large numbers of employees, and involved high operations cost. The second phase began during the 70s and 80s with the introduction of electronic funds transfer, commonly known as EFT. This was one of the first major technological innovations in banking. Instead of moving paper documents between banks, financial transactions could now be transferred electronically. Around the same time, automated teller machines or ATMs were introduced for the first time. Customers could withdraw cash without entering a bank branch. This innovation dramatically improved convenience and reduced waiting times. Banks also began computerizing customer records, replacing paper files with electronic databases. Debit cards and credit cards became increasingly popular, allowing customers to make payments electronically instead of relying entirely on cash. This period marked the beginning of modern banking technology. Evolution Evolution of banking phase 3 and phase 4. The third phase occurred during the 80s and early 90s with the introduction of telephone banking. Banks established automated telephone systems that enable customers to check account balances, obtain account information, and perform simple banking transactions without visiting a branch. Although telephone banking may seem outdated today, it represented a significant innovation at that time because it introduced the concept of remote banking. The fourth phase began in the mid-90s with the rapid expansion of the internet banks. Banks started creating secure websites where customers could access their accounts online. Internet banking completely changed customer expectations. Customers could transfer money, pay utility bills, download account statements, monitor transactions, and communicate with banks from their personal computers. This reduced transaction costs for both banks and customers while improving efficiency. Internet banking also expanded competition. Customers could compare banking services more easily, encouraging banks to improve service quality and invest further in technology. At this stage, banking shifted from being branch-centered to becoming customer-centered. Customers were no longer limited by location or banking hours. This transformation laid the foundation for the next stage, which is mobile banking and the digital banking revolution that we will discuss in the next part of this lecture. Phase 5 and 6. Now let us continue our discussion on the evolution of electronic banking by examining the final two phases, which represent the modern era of banking. The fifth phase is mobile banking, which began around 2010 and continues today. This phase was driven by the rapid growth of smartphones and mobile internet. Before smartphones became widely available, most electronic banking was conducted through desktop computers. However, the introduction of smartphones transformed banking forever. Today, almost every commercial bank offers a mobile banking application that enables customers to manage their finances from virtually anywhere. Using a mobile banking app, customers can check account balances, transfer money between accounts, pay utility bills, purchase mobile airtime, pay school fees, monitor transactions in real time, and even apply for financial products such as loans or credit cards. Mobile banking also introduced several new technologies that improved both convenience and security. One important innovation is biometric authentication. Instead of remembering complex passwords, customers can log into their banking applications using fingerprints or facial recognition. This improves both user experience and security. Another important innovation is QR code payment systems. Rather than carrying cash or even payment cards, customers can simply scan a QR code with their mobile phones to complete the purchase. Mobile wallets have also become increasingly popular. Services such as Apple Pay, Google Pay, and Samsung Wallet allows customers to store payment cards digitally and make contactless payments in shops, restaurants, and public transport systems. The greatest advantage of mobile banking is convenience. Banking is no longer limited by location or time. Customers have continuous access to financial services in 24 hours a day, 7 days a week. Now, let's move to the sixth phase. This is known as the digital banking and fintech era, which represents the current stage of banking development. Unlike earlier phases that focus mainly on digitizing traditional banking services, this phase involves completely redesigning the banking business model. One major development has been the emergence of new banks, also called digital-only banks. These banks operate entirely online without physical branches. Customers open accounts, apply for loans, make payments, and communicate with customer service through digital platforms. Digital banking today is powered by several advanced technologies. Artificial intelligence helps banks detect fraud, evaluate loan applications, and provide personalized financial advice. Machine learning continuously improves banking systems by learning from customer behavior and transaction patterns. Blockchain technology provides secure and transparent methods for recording financial transactions. Cloud computing enables banks to store enormous amounts of information securely while reducing transactions infrastructure cost. Big data analytics helps banks understand customer needs, predict financial behavior, and develop personalized products. Another important concept is open banking. Open banking allows customers to authorize banks to share their financial information securely with licensed third-party providers through application programming interfaces, commonly known as APIs. This encourages innovations and creates new financial services that benefits customers. Another emerging innovation is the development of central bank digital currencies, or CBDCs. Many central banks are currently exploring digital versions of national currencies that combine the convenience of digital payments with the stability of central bank money. Overall, the digital banking era focuses on three major objectives. First, improving customer experience. Second, increasing operational efficiency. Third, promoting financial inclusion by making banking services accessible to more people. The key features of electronic banking. Having understood the evolution of electronic banking, let us now examine its key characteristics. The first feature is 24-hour service availability. Unlike traditional banking, electronic banking is available every day of the year. Customers no longer need to wait for banks to open. Whether it is early morning, late at night, weekends, or public holidays, banking services remain available. The second feature is real-time account management. Electronic banking allows customers to monitor account balances immediately after transactions occur. Whenever money is deposited or withdrawn, customers receive instant notifications through mobile applications or text messages. This enables customers to monitor their finances continuously and detect unauthorized transactions quickly. The third feature is the availability of multiple digital service channels. Banks no longer depend on physical branches alone. Customers can access services through internet banking, websites, mobile applications, ATMs, payment cards, digital wallets, agency banking outlets, and telephone banking systems. This flexibility allows customers to choose the channel that best meets their needs. The fourth feature is remote access. Customers can perform banking transactions from home, the office, while traveling, or even from another country. Geographical distance is no longer a major barrier to banking services. The fifth feature is secure electronic transactions. Banks invest heavily in cybersecurity technologies such as encryption, multi-factor authentication, biometric identification, fraud monitoring systems, and secure communication protocols. Although electronic banking introduces cybersecurity risk, continuous technological improvements make digital banking increasingly secure. Together, these 5 characteristics explain why electronic banking has become the preferred method of banking for millions of customers worldwide. Let us come to the types of electronic banking. Internet banking and mobile banking. Electronic banking includes several different delivery channels. The first is internet banking. Internet banking allows customers to access their accounts through secure banking websites using computers or web browsers. Customers can perform many banking activities online without visiting a branch. These include checking account balances, transferring funds, paying utility bills, downloading account statements, managing investments, and applying for financial products. Internet banking significantly reduces paperwork and waiting times while increasing customer convenience. The second type is mobile banking. Mobile banking uses smartphones applications instead of web browsers. Today, mobile banking has become the most popular electronic banking channel because smartphones are widely available. Mobile banking applications offer nearly all banking services available through internet banking, together with additional features such as biometric login, QR code payment, instant notifications, mobile wallets, and location-based services. Many banks continue adding new features to their mobile applications because customer expectations continue to increase. The third type is ATM banking. Automated teller machine allow customers to perform basic banking transactions without assistance from banking or bank employees. Originally, ATMs were designed mainly for cash withdrawals. Today, modern ATMs provide many additional services. Customers can deposit cash, transfer funds, check account balances, print many statements, change PIN numbers, and sometimes even pay utility bills. ATMs increase banking convenience by reducing congestion inside bank branches. The fourth type is telephone banking, which was introduced before internet banking became widespread. Customers could call automated banking systems or customer service representative to obtain account information or complete simple banking transactions. Although telephone banking is less popular today because of mobile banking, it remains useful for customer support, especially in situations where internet access is unavailable. The fifth type is card-based banking. Banks issue several kinds of payment cards. The most common are debit cards, credit cards, and prepaid cards. Debit cards allow customers to spend money directly from their bank accounts. Credit cards allow customers to borrow money within approved credit limits and repay it later. Prepaid cards contain money loaded in advance and are widely used for travel, online shopping, and budgeting. The sixth type is electronic payment systems. Electronic payment systems enable money to move electronically between financial institutions. Examples include electronic fund transfer, real-time gross settlement, automated clearinghouse, and wire transfers. These systems support salary payments, government payments, international money transfers, business transactions, and many other financial activities. Without electronic payment systems, today's global economy could not operate efficiently. The seventh type is digital wallet banking. Digital wallets store payment information electronically. Instead of carrying physical payment cards, customers can make purchases using smartphones or wearable devices. Popular examples include Apple Pay, Google Pay, Samsung Wallet, and PayPal. Digital wallets increase convenience while reducing dependence on cash. The final type is agency banking. Agency banking allows banks to provide services through authorized retail shops, supermarkets, pharmacies, post offices, or small businesses. These agents use electronic devices connected to banking systems to provide services such as deposits, withdrawals, bill payments, money transfers, and account opening. Agency banking is particularly important in developing countries where many communities do not have access to traditional bank branches. It plays a major role in improving financial inclusion by bringing banking services closer to rural populations. As future banking professionals, it's important to understand that electronic banking is not limited to mobile applications or internet banking. Instead, it consists of an integrated network of technologies and delivery channels designed to provide customers with secure, efficient, and convenient financial services. Now that we have discussed the different stages in the evolution of electronic banking, let us summarize this journey using the timeline shown on this slide. This timeline helps us understand how banking has evolved from a completely manual system into the intelligent digital banking environment that we know today. The first milestone was traditional branch banking before 1970. During this period, every banking transaction required customers to visit a physical branch or records were paper-based, and banking services were only available during official working hours. Although this approach served customers for many years, it was slow, expensive, and inconvenient. The second milestone occurred in the 70s with the introduction of electronic funds transfer, or EFT. Electronic transfer of funds significantly improved the spread of financial transactions, Instead of physically moving paper documents or cash, banks could transfer money electronically between accounts. The 90s witnessed another major breakthrough with the widespread introduction of automated teller machines, commonly known as ATMs. Together with debit and credit cards, this was the first time customers gained access to banking services outside the normal banking hours. The 90s marked the beginnings of smartphones or telephone banking and internet banking. Customers could now communicate with banks remotely and later perform banking transactions online through secure websites. This represented a major shift from branch-based banking to customer-centered banking. During the 20s, internet banking expanded rapidly. Banks invested heavily in online platforms and electronic payment systems became common in both developed and developing countries. The next milestone occurred during the 2010s when smartphones transformed banking once again. Mobile banking applications became the preferred banking channel for millions of customers. Digital wallets, cloud computing, and contactless payments also became increasingly popular. Today, we are living in the digital banking era. Artificial intelligence, blockchain technology, cloud computing, big data analytics, open banking, fintech companies, and digital-only banks are transforming every aspect of banking operations. The important lesson from this timeline is that banking continues to evolve. Technology changes rapidly, and financial institutions must continuously innovate to remain competitive. Let us compare traditional banking with electronic banking. Understanding this comparison helps us appreciate why digital banking has become increasingly important. The first difference concerns service delivery. Traditional banking depends on physical branches, where customers interact directly with bank employees. Electronic banking delivers services through websites, mobile applications, ATMs, digital wallets, and other electronic channels. The second difference is accessibility and availability. Traditional banks operate only during official working hours. Electronic banking operates 24 hours a day, 7 days a week, allowing customers to perform transactions whenever they choose. The third difference involves transaction speed and convenience. Traditional banking often requires customers to travel to branches, wait in queues, complete paper forms, and interact with bank staff. Electronic banking allows customers to complete most transactions within seconds using smartphones or computers. The fourth difference relates to cost and efficiency. Traditional banking requires buildings, paper documentation, and large numbers of employees, resulting in higher operating cost. Electronic banking reduces paperwork, lowers operating expenses, and improves operational efficiency. Finally, let us consider the customer experience and risk. Traditional banking offers personal interaction and face-to-face advice, which remains important for complex financial services. Electronic banking offers greater convenience and speed up, but introduces cybersecurity risk, such as hacking, phishing, identity theft, and online fraud. Therefore, modern banks generally combine both approaches. customers still visit branches for complex financial decisions, while routine banking transactions are increasingly performed electronically. This hybrid model allows banks to provide personalized service while benefiting from digital efficiency. Although electronic banking offers many advantages, it also presents several important challenges. Understanding these challenges is essential for future banking professionals. The first challenge is cybersecurity. Banks store enormous amounts of sensitive customer information. Cyber criminals constantly attempt to steal financial information through hacking, malware, ransomware, and phishing attacks. Consequently, banks invest millions or billions of dollars annually in cybersecurity technologies. The second challenge is online fraud. Fraudsters continually developed new methods to deceive customers into revealing passwords, PIN numbers, or one-time verification codes. Customer education is therefore just as important as technological security. The third channel concerns data privacy. Banks collect significant amounts of customer information. Protecting this information and complying with privacy regulations are major responsibilities for every financial institution. Another challenge is dependence on technology infrastructure. Electronic banking requires reliable electricity, internet connectivity, communication networks, and secure computer systems. Any interruption can temporarily prevent customers from accessing banking services. Another important challenge involves technical failures, software bugs, hardware failures, system maintenance, or network outages can disrupt banking operations and inconvenience customers. Finally, electronic banking requires digital literacy. Not every customer possesses the knowledge needed to use digital banking safely. Older customers, rural populations, and individuals with limited technological experience may require additional support and education. Despite these challenges, banks continue improving security, reliability, and accessibility. Continuous investment in technology and customer education helps reduce these risks and strengthen customer confidence. Now let us discuss one of the most important concepts in modern banking, digital transformation. Digital transformation is much more than simply introducing computers into banks. It involves redesigning the entire banking business model. Banks rethink how they communicate with customers, process transactions, manage risk, develop products, and make strategic decisions. The objective is to create faster, smarter, and more customer-focused financial services. Digital transformation improves customer experience by providing personalized services and faster responses. It reduces operational cost through automation. It strengthens security through advanced monitoring systems. It improves decision-making by using data analytics. Most importantly, digital transformation encourages innovation. Banks continuously introduce new financial products and services to satisfy changing customer expectations. Today, customers expect banking services to be as simple as using social media or online shopping platforms. Therefore, banks must continuously innovate to remain competitive. Digital transformation has become a strategic necessity rather than a technological option. Banks that fail to embrace digital transformation risk losing customers to more innovative competitors, including fintech companies and digital-only banks. Key technologies driving digital transformation. Digital transformation depends on several advanced technologies. Let us examine each one briefly. The first technology is artificial intelligence, or AI. AI helps banks automate customer service through chatbots, detect fraudulent transactions, assess credit risk, provide personalized financial recommendations, and improve operational efficiency. The second technology is cloud computing. Instead of storing information only on local computers, banks increasingly use cloud platforms to store data securely, reduce infrastructure costs, and improve flexibility. Cloud computing enables banks to expand their digital services quickly while maintaining high reliability. The third technology is big data analytics. Banks collect enormous amounts of customer information every day. By analyzing these data, banks gain valuable insights into customer preferences, spending behavior, borrowing patterns, and financial risk. This information supports better business decisions. The fourth technology is blockchain. Blockchain creates secure, transparent, and tamper-resistant digital records. It is particularly useful for international payments, trade finance, and reducing fraud. Another important technology is mobile banking. As we discussed earlier, smartphones have become the primary channel through which customers interact with banks. Banks therefore continue investing heavily in mobile applications. Finally, automation and robotic. Process automation, often called RPA, enables banks to automate repetitive administrative tasks. Processes that once required hours of manual work can now be completed automatically within minutes. Automation reduces cost, minimizes errors, and allows employees to focus on more valuable activities such as customer relation management and financial advisory services. Together, these technologies are creating a new generation of intelligent banks that are faster, more secure, more efficient, and better able to meet customer needs. I advise my students to solve the review questions from slide 17 to slide 21 and upload their answers to the Telegram group we have created. Let me summarize the lecture. Before we finish today's lecture, let us summarize the most important ideas. Today we learned that electronic banking is the delivery of banking services through electronic channels rather than traditional bank branches. We examined the 6 major stages in the evolution of electronic banking, beginning with traditional banking, followed by electronic fund transfer, telephone banking, internet banking, mobile banking, and finally today's digital banking and fintech era. We discussed the major types of electronic banking, including internet banking, mobile banking, ATM banking, telephone banking, card-based banking, electronic payment systems, digital wallets, and agency banking. We compared traditional banking with electronic banking and found that electronic banking offers greater accessibility, faster transactions, lowering operating costs, and increased convenience. We also examined the challenges facing electronic banking, including cybersecurity risk, online fraud, data privacy concerns, technology dependence, and the need for digital literacy. Finally, we discussed digital transformation and the technologies driving the future banking, including artificial intelligence, cloud computing, blockchain, big data analytics, mobile banking, and automation. As future banking professionals, it is important to understand that digital transformation is no longer simply an innovation. It has become a necessity. In our next lecture, we will continue building on these concepts as we explore more advanced topics in electronic banking, digital payment systems, and financial technology. Thank you very much for your attention. I hope you found today's lecture informative and engaging. Please review the slides, revise the key concepts, and attempt the review questions once again before our next class. I look forward to seeing you in the next lecture. Have a wonderful day.